Welcome to the premiere of Options Action, your front row seat to the smart money. I'm Melissa Lee. Here's where the action is tonight.
One of the things is whenever you see one company in a sector get into trouble, then another, a pattern is developing, right?
Exactly.
You have to recognize that there's a pattern going on.
Clearly.
How can we believe that this is the only company that's going to dodge all these bullets? It just seems impossible to me.
I'm not sure if I wanted to be reminded what I looked like nearly 20 years ago, but that was the premiere of Options Action. When that show first started, somebody brought it up on a recent live stream, and then somebody from CNBC happened to send me that snippet, and so that is what I looked like the first day I ever appeared on CNBC. My, how things have changed, and not necessarily for the better, but you know, when I was first approached about doing a book, and also approached about doing business news television, I was not yet 40 years old. And now I'm in my mid-late 50s. So things have changed quite considerably. One of the things that has not changed so much is that we were reminded once again over the course of the last week that we are navigating an unusual transactional geopolitical landscape. Where policy is often used as a tool for leverage rather than a fixed set of rules. And that poses some real challenges for investors in this kind of on-again, off-again posturing. And it creates this sort of constant underlying state of unease and sometimes volatility. And one of the things I was thinking about as I was awaiting the president's comments at Davos, which seemed to have calmed things down quite considerably. And I can appreciate, by the way, I'll just throw this out there. Those of us who comment about the markets, it's not uncommon for people who follow us on social media to make comments and say, stay in your lane, don't talk about politics and things like this. The issue that I have with that, though, of course, is that the markets are very heavily influenced by them. And, if you think about it, perhaps in the United States, at least, if we think about all of the debt that is outstanding, maybe 44% of that debt is government debt. A considerable portion of all of the spending that goes on in our economy is government spending. So we really can't ignore it. And then, of course, we also have to navigate the fact that risk assets are going to be impacted by how much risk people think that there is in the market, and that is going to be affected in turn by the relationships between countries. So, first what was going on in Venezuela, and then Iran, and conversations about, Greenland. All of these things have contributed significantly to volatility, and we saw that over the last couple days and weeks. And it got me thinking a little bit, okay, well, we often talk about options, so why don't we talk a little bit about volatility and how one trades volatility? This is an issue I've brought up once or twice in the past, but I thought I would bring it up again now, just so we have a sort of an understanding and a level set about how those of us who used to trade options as market makers would think about the price of options and how you would scalp volatility. And as an example, what I did was I just went back 2 weeks here, and now you're going to see a jumble of things on my screen right here, but let's just talk a little bit about what this is. In this example, I just went back 2 weeks from today, back to January 7th, and I assumed that you did not know what the future was coming, so you were not going to make a directional bet. This was just a sense that maybe volatility was going to go higher. We knew that Davos was coming. There were some other things happening. What might one have done? Well, something you could have done, and it's not really important that you can make this out because these are actually just Bloomberg tickers. It's not important to pay too much attention to what these are, but I'll just tell you what instruments they are. This involves purchasing what would have been on that Wednesday the at-the-money straddle in SPY that expires at the end of the month. So the last trading day of January is the 30th. So I realize there's 31 days in January, but the last trading day is the 30th. I'm going to actually construct this quickly so we can have a peek at it, what that strategy would look like. But when folks talk about options in this way, you know, whether it's on CNBC or some other context, they usually have this kind of set and forget mentality, which is that, you know, you bought the stock, you sold the call, you wait, and then you adjust. Volatility traders don't generally do that. They hedge their exposure to the underlying market because they're not making a bet on the market's direction, only on volatility itself. And that changes as the underlying price moves. I'm going to display that in just a second so we have a better sense of it. But this is the strategy just starting out. So the strategy would be that 2 weeks ago, one would have purchased the at-the-money straddle that expires at the end of the month. So we're going to go to January 30th. Here we are. That would have been the 690s because that's approximately where SPY closed on that day. So long the 690 puts and long the 690 calls. And you get a strategy that looks like this, right? If it breaks strongly in one direction or the other, you see profits. And if it stays within these two break points, which is 677.73 on the downside and 702.30 on the upside, then, and that's as of today's prices, by the way, then you're going to lose money if it's between those and you're going to make money if it's outside of them. But volatility traders aren't doing that. What a volatility trader would actually, they don't just buy it and then just wait and see. Instead, what they would do is they would have bought it. These are the closing prices as of that day. So the calls were 916, the puts were 815. So you're looking at round about 1730 to purchase that at the end of the day. They want to be delta neutral. They're not making a directional bet. They're only betting on volatility. So if you had bought one, that would cost you $1,731. Very close to at the money, but not perfectly. The calls had slightly more delta than the puts did. So to be perfectly delta neutral, then you would have sold some stock to offset it. So if you'd bought one straddle, you actually would have needed to have sold 6 shares of SPY to be delta neutral. Now, in my example, you can come up with your own hedging regime as you see fit. In my example, I'm just assuming that you calculate what your deltas are close to the end of the business day, and then you just have a market on close to either buy or sell whatever number of shares you would need to get back to that delta neutral position. And of course, I'm rounding here, right? So the actual deltas, you know, would be some fractional share, but we're going to assume you're not trading fractional shares. So if there's enough to trade one share, you would do that. Otherwise, you would not. Okay, so on the first day, you would have bought the straddle, paid $1,731. You would have sold 6 shares of SPY to get delta neutral and collected $4,137. On the next day, prices had moved very slightly, not much. You can see it was only a 7-cent change, but there was a slight adjustment in the net deltas, and actually net of rounding, you actually would no longer have 6 deltas, but it would be 5. So you could buy one of your short shares back. On the very next day, the stock would be was up about $5. And because you're long gamma, if you're long gamma, that means you're getting longer deltas as the stock price rises. You're getting shorter deltas as they come in. Now you have 23 deltas, so you can actually sell 19. And so on. So basically, these are the transactions. You bought one here, you sold 19 there. Every day, the objective being getting as close as one can to delta neutral. On the biggest day, which would have actually been yesterday, you would have bought 65 shares on the close because SPY had declined precipitously. You're trying to get back to that delta neutral position. And then today, you actually would have been a seller. And actually, I imagine, I'm not sure that that price is completely current, so let's see where it closed. SPY closed, oh, it did. Okay, that's pretty close to the closing price. 685.03 I have here. Looks like 685.40 was the close. And all of those transactions along the way would have resulted in some P&L. You were selling some stock as it rose, you were buying some back. And this, by the way, would be your net position now. You'd be long 21 shares net of all of these transactions. And this, by the way, is your P&L over here. So the straddle has gone down in value. It was $1,731 to buy one straddle on that first day, and it's gone down by $500 in the meantime. But you made $635.76 trading the stock, selling when it rose, buying when it fell, and net, you'd actually be up money. So up about 7.8% on the original risk. And the risk in this case was really the value of the straddle, because all of the stock trading that you would be doing is effectively hedged by the fact that you have both calls and puts. So really, when you think about it, when you buy a straddle and then you hedge it, the worst thing that could happen to you is that for whatever reason the options went out worthless and you made no money trading the stock. So if you bought it and the stock did nothing, it never rose nor fell, or it never rose or fell enough that you actually had to adjust your deltas, then you would have made no P&L trading the stock in the meantime. And that's why we think about it as trading volatility, because if you bought the straddle, you need that volatility, and the way you harvest that volatility is by delta hedging your options. Okay, so I thought this would be kind of useful in the sense that, we often talk about options positions as if they are these static things, like you do it and it just sits there. But I wanted everybody to just sort of have this, understanding that from an options trader's point of view, from a volatility trader's point of view, you're really, you're either long or short volatility on the option side, and you're trying to hedge that with the underlying asset if all you're doing is strictly trading volatility. Now, sometimes you might not be doing that. More often than not, when I'm trading options on the short side, I'm not delta hedging. That's something I would be more inclined to do when I'm long options. And believe it or not, there's actually reasons to do that too. I've talked a little bit about this, and I don't want to go completely down this. It can be a little bit of a rabbit hole. But in truth, when you take a look at volatility over longer periods of time, it tends to be lower if you're measuring it, say, week to week or month to month, than volatility would be if you trade it day to day or intraday. So we make these assumptions that stock prices, follow a certain behavior, geometric Brownian motion or something like that, and that you can therefore make predictions about how much they're going to move around based on time intervals, but that doesn't prove to be completely correct. The short version of it is that if you are long options, it typically makes sense to try to harvest some of that volatility more quickly than it does to try to hedge your deltas if you're short options. And in fact, Bruno Dupure, he's the head quant at Bloomberg. I've mentioned his name a couple of times over the years. He has a whole sort of theory about this, that you should trade day to day as if you're long options, and trade week to week and longer intervals as if you are short. FinWest, you just asked, do you discuss this vol trading strategy in your book? We discuss these concepts for sure. So yeah, I'm providing us kind of a specific example here, but the short version is, we absolutely do cover these concepts. And we're not the only ones that do. Shelley Natenberg does in Options Volatility and Pricing. Hull does in, what's the name of his book? I'm trying to remember what the name of Hull's book was. And then Cox and Rubenstein had a book out called Options Markets, I think. So they discuss it. It's kind of a well-understood concept amongst the volatility trading crowd. And in fact, it's not just something that you do, it's something that you must do, because if you are a market maker in options, typically you're running a lot of leverage. And you can't trade volatility and just take punts, directional punts. I know more than one person who was supposed to be trading volatility who decided that they were going to incorporate some directional bets because they started to get an ever stronger view about the underlying asset. and they didn't keep their jobs as a result. So in vol space, typically you're not supposed to be making directional bets. Happens sometimes, just sort of as a byproduct of things moving around. But I just thought that would be kind of helpful to think about it. And, there are OTC products that a lot of people trade, mostly in the interbank market, like variance swaps and stuff like this, which are also sort of bets on volatility, things to think about. All right. So with that said, why don't we move on and take some of your questions here. So, would you buy a bull call spread on Schlumberger going into earnings on Friday? So, as it happens, and maybe you knew this already, Ranjana, Schlumberger is one of my stocks for the year. Now, quick point about the acronyms that are chosen for CNBC. They changed the rules up a little bit this year. So the acronym has to be a word. So it can't be just some random assortment of letters. It has to be the letter in the acronym. This was, some people sort of didn't quite play by the rules in the past. But the letter has to be the first letter in the ticker for a respective symbol. And this year, you can't have more than 6, because a couple of years ago, I came up with an acronym, and I sent it in, and I said, Bond Vigilantes, and they said, no way, that's way too many letters. You can have as many as 6. So you can have up to 6 letters. And the new rule that I think they've introduced this year is that once a quarter, you're allowed to pull one out and put a new one in. So you actually have the ability to make some adjustments. Now, I bring all of this up because, in the grand scheme of things, my view is that you should have sort of an overarching investment thesis, and you shouldn't tinker with it that much, and you probably shouldn't tinker with the parts that are working while they're working, and you should only tinker with them once they stop working. And I mention that because a couple of years ago, my acronym was BRAVE, where the B was for Bitcoin. Bitcoin was obviously working in 2024, not so much in 2025, but it was part of 24 and 25. Also part of it were the gold miners. That was by ticker symbol AU, which was the A in Brave, Anglo Gold Ashanti. And for those of you who watch this live stream, you know that I still liked gold going into 2025, but I had a new acronym. They didn't want 2 Gs, so we ended up ditching GLD, which would have been my proxy. But had you been an Anglo Gold Ashanti, that actually outperformed gold in 2025, and it would have been a good place to stay. So I throw that out there so that, it's not, when I come up with these things, the idea that, you should just ditch the old ideas and pile into the new ones. But if you're deploying new capital, what are the things that I rather like today? So for that, this year's was faster, and the S was for Schlumberger. Really, the idea here was that I wanted to have an energy component. Schlumberger is the best known and largest of the oil service companies. They have exposure to a lot of different areas. As it happens, they probably would be best positioned to provide services in Venezuela. So to the extent that U.S. oil companies, oil service companies, E&P companies, or whomever have anything to do with a potential rebuilding of the Venezuelan oil industry, which is in very severe disrepair. I mean, their production is a small fraction of what it used to be. Schlumberger could potentially be positioned. So that's sort of my underlying thesis for Schlumberger. We'll do what we always do, which is take a quick peek and see what the financials look like here. Not like that, we're not. Here we go. And as you can see, and this is actually true for a lot of companies in this space, oil prices are depressed. When oil prices are depressed, the values of oil companies and those that service them will also tend to be. Right now, it's trading at 16.5, 16.7 times next year's anticipated earnings. Very nice free cash flow, as we can see here. So relative to enterprise value, it's like 5.6% cash flow to EBITDA, and if you're looking at free cash flow relative to the company's valuation, 72, we'll just call it 72.5 billion, 6.4%. By the way, in the same vein for energy, one of the companies that I just recently wrote about, I don't know if I mentioned this on Monday. I don't think I did, but I'll mention it now just in case, was NFG, which is National Fuel Gas. So this company, for those that don't know, it's kind of an interesting, this is one of the oldest energy companies in the United States. They drilled their first gas well in New York in, I think, 1825. And it was to power a village's street gas lamps in that area. That was only 7 years after the first gas street lamps appeared in the United States at all. Those were in Baltimore. And the precursor, what that business was, ended up by the late 1800s and early 1900s becoming part of the Standard Oil Trust, which were the Rockefeller Trust oil interests in that portion of Pennsylvania and New York, Buffalo area, and so on. And the company actually had a corporate action recently. They acquired some assets in Ohio. This is a company that has both regulated and unregulated business. So I wanted to just mention that as a stock that I also kind of liked in the space. So I'm not really huge, I will say, on just taking punters going into earnings, but I do like the energy space in general. So if I was going to make a bullish bet, I think a call spread is a fine way to play it, although I would probably use a call spread risk reversal because I'm comfortable owning the stock and I don't want to pay the decay. Right? So that way you're going to, and also, I mean, I can understand it. This stock was actually down, I think, yesterday fairly sharply. And now, of course, everything ripped today, which makes it that much harder when stock's up 5%. Well, it's not quite 5%, but the stock's up as sharply as this one is. But if we take a look in here, you can see that we had this big gap up. Well, maybe you can't really tell right there. Let me see if I can blow this up a little bit. So we had this big gap up here, and I have a feeling that this was in part fueled by the comments I was making RE Venezuela. I have a feeling that they're going to downplay that a little bit if they're asked about it on the conference call, because there's a lot of uncertainty about this, and it's going to take many years for that to get online. And frankly, just yanking Maduro out doesn't necessarily mean that everything is going to go back to being hunky-dory. Be that as it may, this would be an interesting opportunity, I think, for something like this. So we're going to go down here and, get a structure that might look a little bit like that, like a 45, 50, 55 call spread risky for essentially no money. The wings will come in a little bit harder if and as they report earnings, because there's going to be a little bit of a vol crush. That's part of the issue that you are contending with, is that implied volatility is going to fall as the catalyst comes and goes. So, a spread like this is a way to sort of take advantage of that. But I do like Schlumberger. Just wish it hadn't had this big rip up before we had a chance to talk about it. But call spread risk reversal. The downside is you get long the stock at 45. That's down $3.50 from where it is, which is not a huge discount, but it's more than the amount that the stock popped today. Okay. So, Finwest, Aloha Mike, I believe you run a daily stock scan. Given the criteria you've mentioned, I suspect the stocks don't vary much each day. Would you be willing to share a one-day results with us? Thanks. Yeah, sure. I make minor tweaks every now and again because I'm always trying to see whether there are factors that I'm missing. I'll give you a really good example. I was actually talking to Mark Guthner about this just yesterday. We didn't get to do office hours, but it was just something we were talking about. And I was saying, there are circumstances where we it would be helpful to try to identify thematic trades where there is no meaningful operating history to work from. And it was actually prompted by a question that came up on this live stream when somebody was asking on Monday about GE and GE Vernova. And I was thinking about GE Vernova, and I was, my principal issue was that I do think there's a meaningful opportunity for the company. It's not a super compelling valuation where it stands right now. And because GE had all of that tumult and then they were spinning off into different units, there isn't that much operating history, and that certainly not a whole lot of operating history where you can track a stock price. And it occurred to me, I said, this thing has had such a run, it should have been on my radar sooner. And why wasn't it? Well, I mean, it wasn't publicly traded on its own. It wasn't profitable. There was negative free cash flow. There were a lot of reasons why it wouldn't have sort of percolated to the top of my daily screen. But thematically, it makes a lot of sense that the companies that are making the components for energy generation we're going to be in a good spot. We know that that's a hot trade. It's one of the things that's propelling uranium. It actually is part of my thesis in Fluor, a company I've talked about before, and is the F, by the way, in my FASTER acronym. So how would I identify stocks like that a little bit more quickly? And what I've kind of landed on is that I'm going to have sort of a special carve-out bucket where I'm just going to start looking at, just strict technical screens, looking for, stocks that appear to be breaking out. And then, unfortunately, there's no really good process to filter down into those. You actually have to go and say, okay, well, here's one that's breaking out. What do I think? And kind of go through the exercise that we were going through where we were saying, okay, well, GE Vernova is not making much money right now. It's trading at 50 times forward earnings. Why is that? And then taking a look at competing companies and saying, okay, well, they're in a growing business. We expect the top line to continue growing. It is probably an order book with some considerable lag to it. And ultimately, we would expect, with the demand that we expect to see over the coming years for additional generation, that their margins would converge to their competitors, which is going to get you in that 11, 12, 13% net income margin area. And if you get there, then the company's probably trading around 20 times full year 2028 numbers. Okay, so all of that said, then, how might we then go and take a look at, and I thought I had, where is this? Oh, did I close it? It's all right, I can rebuild it because I do the screens pretty frequently anyway. So let's, I must have covered it up. It's all right. So it doesn't take me very long to run these screens. So you guys know basically the things that I'm trying to take a look for. I don't want any companies that are, I'm going to screen out companies that are below their long-term moving average. We'll just start with that. So I'm going to take companies that are above the 200-day moving average. I want to see companies where growth is accelerating. So from that, we can just go right to their performance metrics. And just going to say I want to see that the last 12 months EPS growth is greater than the 5-year CAGR. Same thing for sales. We can do that. Oops, am I on the right? Nope, I'm in the wrong one. Sorry. All right. I don't want any negative revisions. Negative revisions, I think I've had this conversation with all of you. Generally, stocks don't perform well over the ensuing 30 days. When they have negative revisions. So we'll just go here. I'm only going to put in a negative number. I want it to be greater than this. So I don't mind if it hasn't had any revisions. I just don't want one that's had negative revisions. I don't want to have, this is just sort of a quick and dirty one for this exercise. I don't want to have a PEG ratio that's greater than 3. And so to your point, we could do some additional filtering if we want. Feel free to chime in if you like. But to your point, the names on this list don't actually change that much. It's one of the reasons why I use basically the same parameter set And I will do minor tweaks here and there. So I'll just kind of make massages around this to see whether I can find stocks that are on, the periphery that weren't showing up, but now might. So unsurprisingly, we've got Ralph Lauren. Here's another company that's showed up in my acronym. Let's see here. So I don't know how the best way for me to share this with you. Maybe somebody on the production staff can say. Let's do, I can actually, we'll maybe just impose one additional restriction on this because this list is a little bit on the long side. I kind of want to give you guys something to screenshot here. And I had normally what I'll do is I'll take something like sales growth and just say that I would like to see numbers that are at least as fast as the pace of economic growth. So we just put in or inflation. You've heard me say that. And you get this list of stocks. So this, by the way, just so we understand what the screen does, the screen is not. This is page 1 of the list. This is all there is. There's only 20 stocks. Yeah, it starts. Yeah, okay, so that's right. Someone paying attention is noticing that it starts at 31. When you see these screens, and I'm not sure what Bloomberg's doing there, but they often do. This is basically starting at the beginning. So I want to quickly describe what this is. So this is not necessarily the only stocks that I would own. What is the purpose of this screen? The purpose of the screen is to say what are stocks that, based on this criteria, might I consider adding today? And then I'll massage some of these numbers around. And you'll probably be completely unsurprised by some of the things that show up here. Like I said, Lilly, not a surprise. Ralph Lauren fell off of one of the little screens that I just imposed right here, but Ralph Lauren is the name. Corning, which is also tied to the AI trade in its own way. Goldman Sachs has been posting some pretty solid numbers. So you'll notice that this showed up here. And like I said, because I massage usually one field each time, so I always start here and then I'll, sort of go back and forth on a couple of the factors. The list, to your point, doesn't change very much. But other names that have shown up on it, that Zion's not going to show up here. That could be because of this. Let's see. But I know that Zion's was on one of the lists I was running today. There it is. Yep. So, Zion's is in here. Restoration Hardware. So this is kind of an interesting, well, I don't know that they go by the name Restoration Hardware anymore. I wrote a story about Restoration Hardware, I think it was last June. And this is a name that also has kind of surprised me a little bit because the housing market is obviously in considerable distress. Housing affordability is very poor. Restoration Hardware has managed to hold up pretty well. I'm not super excited about it because they've taken on a little bit of debt. I'll just show you what I'm talking about. But it is always interesting when these types of names show up. And so, for example, right here, you can see last 12 months, 9.7% year-on-year revenue growth. Looking at 9% for the full year, 9% for next year also. And, the expectation is that full year earnings are going to be in this $10.20 adjusted is the anticipated number, which gets the company trading at around 20 times, which, given its growth, top and bottom line, is slightly better than the S&P overall. Is it better enough that I would necessarily start loading the boat and buying this thing? No, not necessarily. Let me just quickly make a couple points, why. So stocks can meet the screen, and then I'll look at them and say, I don't not that crazy about it. What are some of the reasons that I wouldn't be as crazy about it? They have higher tariff exposure, so we'll wait and see what happens with tariffs, but They import a lot of the stuff that they sell from Asia, so there's tariff exposure. They have a lot of debt. I don't know if you can see this. So in round numbers, they got $4 billion worth of debt, $40 million worth of cash. So, debt to equity is almost 50-50 here. So that's a little bit troublesome. It's a consumer name. I expect to get it at a discount to something well diversified like the index overall. But it's interesting that it showed up, is my point. So let's just get back here again. I'm just going to sort of filter through here. 31, we're starting at, I don't know that how we want to sort this, if it even matters. You know what? Let's do this. It's sorted right now by revenue growth, from the fastest growing to the one that's not growing as quickly. So I think this is probably as a good a way to take a look at it as any. So anybody who's interested, you want to do a screen grab, or if you want to come back and watch this, or pause the video or do whatever you want to do. I'm just going to go down to here. Now you'll notice that some of these names that are down here at the bottom got dropped because I also impose a revenue growth filter usually. But once again, you can sort of take a look in here and see what's going on. I think a defense name like RTX, not a terrible place to be. Johnson & Johnson, fairly defensive as well. Some of these multiples, like on the money center banks, I kind of feel like they've had a good run. But we talked a little bit about the regionals on Monday, and I know that one of you had an interest in Zion, so I hope that helps. Okay. Hi, Mike. Are you bullish on any oversold software names? Like ServiceNow, Oracle, Adobe, and Salesforce. Okay, so let's talk about two of these that I'm not hugely in favor of for their own reasons. Oracle being the first. And, I want to say right off the bat, this just happens to be my own thing. They are, they're taking on a lot of debt to do the stuff that they're doing. So they're making massive, massive commitments and investments. And I'm not, I think we talked about this a little bit before, that, the Ellison family, the younger generation seems to have its eyes more on Hollywood than on their traditional business. And Larry Ellison himself is, he's getting up there. There are other names I'd rather play in the space, sort of best of breed type things. But this is the part that gets me a little bit concerned, where Oracle is concerned. $124 billion worth of debt, and we're looking at negative free cash flow pretty significantly. Is that going to prove to be a good look? If all works out as planned, that leverage will actually come to be to their benefit. But it's it's not for me. I feel like there's other places I can play in the space that have good positive free cash flow, and so I just as soon be with those. Adobe. So Adobe exists in a lot of places where they once dominated their space, but it is not as true as it once was. And I'll admit that there's a couple businesses where I've thought, okay, maybe they're getting cheap enough that you kick the tires anyway, even though the secular wind at their back no longer is. This would be, Adobe would be an example of this. Maybe Trade Desk would be another. Which I happened to throw into my acronym because I needed a T, and maybe that wasn't the best one to choose. But, this is getting cheap, Adobe is. The forecast for their revenue growth numbers, and this is true for Trade Desk too, would suggest that it's very cheap. And the free cash flow would suggest also that it's very cheap. But it is not priced as if these numbers are real. I guess that's the simple way to put it. If these numbers were real, this thing is a screaming bargain. But it's not trading that way. So if you're inclined to, reach out there with some speculative money, just saying, okay, well, and also if you happen to have any unique insights into their products, their offerings, their markets, and said, okay, I think that Adobe Premiere, for example, I'm just picking a product out of the clear blue sky. But I think that actually that the pressure on that product is overdone. I think they're actually going to have some uptick. They're not going to lose everything to the Da Vinci's of the world. Then great. If you think that there's any truth to these numbers, then this thing is clearly a screaming buy, right? I mean, it's trading, 12 times 2027 numbers, a little bit more than that versus fiscal year 26. So certainly it's looking cheap on that basis. But, I'm not as enamored of it simply because I feel like there are cracks emerging in their underlying business. And that's, it's important to recognize that, it's very tough to get really strong conviction, to feel like, okay, everything's lining up here. That I think that they have a great moat around their business and the underpinning industry is growing. That I think that the technicals look good and that the stock looks cheap and that, all of those things, lining them up in a universe of, if I'm just looking at the Russell, which is what I usually filter on, 1,000 stocks, the number of stocks that I'm going to say, okay, yeah, let's buy them here is usually not that big. And, it's not just me. You can see we have some actively managed funds. How often do those stocks move around? Not that often. But you keep your eye on it and you say, okay, well, if there's room, it's moving up the ranking. And, in Adobe's case, I feel like the moat portion, that's where the trouble is. I think that's why the company is trading at the valuation it is. But if you have additional insights on this, and you think that their business is fundamentally stronger, and when I say fundamentally, I'm not talking about its price to earnings. I'm talking about, do you think that the product they sell is going to be in demand, that they can price it where they want to, that they can preserve their margins? That's, the other part of fundamental work. And that's really the thing that's going to matter to those. And Eric, on a related, so Salesforce, you asked about ServiceNow and Salesforce. I just want to touch on Salesforce real quick. One of my issues with Salesforce historically was that when you looked at their earnings, the problem was they had such aggressive equity comp to their employees that on a fully diluted basis, very little seemed to go to the shareholders. That situation has gotten much better. And they also had some layoffs recently. So it seemed like the company is sort of focusing more on the shareholder now. And the valuation has come in. So on that score, generally, I do actually like Salesforce here for what it's worth. It's easy for me to skip from one question to the next without getting to it. But I've got Netflix in my eye because Netflix got hit on earnings. I have described Netflix. Now, Netflix, obviously, they've got the deal issue, Warner Brothers and all that, that's sort of clouding things up a bit here. But we haven't really had an opportunity to kick the tires in this one at these kinds of numbers. I like it here. We have, how much do we have in it? We have fairly decent piece in Netflix. Let's see here. What we got? $76. Yeah, so we have not quite a million shares of it. And what about over here? Did we stick any in this one? Not yet, but this was a topic of conversation earlier today. This is very interesting because I don't think that I mean, they're the best of breed in the streaming space. It's as simple as that. And I think they're very well positioned. There is some concern, obviously, about the spend on Warner Brothers, sort of getting away from their core business. You know, it's interesting. Once upon a time, the biggest knock on Netflix was that they were forever going to essentially be beholden to the actual content creators. So if you go back to 20 years, if you go back to when that options action video was made, that was the knock that they would make about Netflix, is that their content costs were just going to go up and up and up, and how were they going to contend with that? And they were never going to actually make any money. And now, fast forward, and they're dominant in the industry, and everyone is all in a twit about the fact that they want to own the whole thing, soup to nuts. And I don't think being in the narrative content creation business is a bad idea for them. And if they can get it at a reasonable valuation and they operate that somewhat efficiently, I think that's a positive. What do we got them trading at now versus next year's numbers? 530, or even full year this year. Let's do that first. 27 times, 24% year-on-year growth, and %3 free cash flow for this year, but anticipated to grow at, let's see, you guys are probably doing the math faster than I am at this point, with 25% year-on-year free cash flow growth. That seems like a pretty reasonable and compelling story to me, and like I said, they do have the moat because I think they are the best of breed. So I like it here. 3-day roll in effect. So technically it's kind of in a, it's not like you're going to miss it because, it's still rolling over from the earnings fallout, which we just had. But let's just take a look at what we think might be an interesting level to get into it. Actually, we might be getting to that level right now. Let's take a look at these recent lows. So where are we going to get? That's the only tricky bit, is that this is kind of that number. We're tinkering with it right here. 3-day rule in effect, I would probably wait until Friday and see whether we can hold right here. If we catch a good bounce off of this level, which is, what is that, about $82, right? So as long as we hold above 82 through Friday, I think this is starting to look very interesting here. If we violate that, we'd have to actually see what the next level down would be. But yeah, I think this is really quite interesting. So, Alex, hi Mike. I think you were discussing a similar SPY straddle strategy a year ago, but with a 30 delta. It's possible. I bring this up from time to time because I don't know how many people have been watching in the past that are still watching now, or people that have recently joined, and when we talk about volatility are wondering what it is I'm talking about. It just has to do with trading the price movements of the underlying back and forth, and whether or not the options are fairly priced to capture that, and so on. But yeah, I think it's important just to remember that, and from time to time do it. Oh, I know what it was. When I was talking about it, I doubt I was talking about a straddle, a 30 delta straddle, because that would just be a call and a put of the same strike, same expiration, where either the call or the put happen to be, have a much higher delta. And that's not where I would typically initiate. But I was almost certainly talking about a strangle. Because one of the things I was doing when implied correlation got really low, that is to say that the price of index options had gotten exceptionally cheap relative to the price of single stock options, was I was buying SPX strangles. And then I would hedge those. So I think I was buying a 30 delta SPX put, and I think it was a slightly lower delta upside call, but probably comparable moneyness, and then hedging that. And, you know, the whole idea was that if we got a big price jump that I could capitalize on. So, yeah, good on you for remembering, but that was very likely what you are remembering, was that because I was using SPX strangles, delta hedged against my core equity book at that time. And that was because implied correlation had gotten very low. But yeah. Okay. Sicilian Ambassador. I have a tech-heavy portfolio and was looking for a good hedge to keep in place. It appears that an SPX Collar is a no-brainer. Any recommendations? Thanks. Yeah, or a put spread collar. So I think it depends on just how much you... So one of the issues that I have with just a straight collar, and I'm going to build it in SPY because it's easier for me to construct it in here. So one of the issues that I have with just a straight collar, so let's just assume that you own, yours is a tech-heavy portfolio, but let's just say for the sake of argument that you own SPY. Okay, so if you own SPY, you have this, a linear payoff. Goes down 1%, you lose 1%, goes up 1%, you make 1%. Easy enough. What's a collar? Collar is you buy a downside put for protection, you sell an upside call to finance the purchase. Couple ways you can do that. You can say, all right, well, I'm going to buy a put, sell a call, and I'm going to use equal moneyness. So let's say I want to buy a 5% out of the money put, and that's going to take us to, call it 650. So I'll buy the 650s, 650 put, and sell at 5% on the money call. You're going to see where I'm going with this in just a second. So I buy 5% out of the money put, and I get a 5% out of the money call. So that's going to be, yeah, it's going to be up around, let's go up to around 720. Something like that. Right? Is that about right? Okay. What are you going to notice here? You are going to notice that I have 5% upside-ish. And actually, it's going to have to be a couple. It would be either the 720s or the 725s. But it's going to be, to get an upside strike that's about as far away from the downside strike that I'm buying, you're going to end up with this situation due to skew, in part due to skew, which is that the put that you're buying is going to cost you $6.32, and the call that you're selling is only going to bring in 2.25. So you end up with a standstill negative yield of just over $4. This expires in 58 days. So essentially you're creating a headwind of $4.10. So over 56 days. So that's 60 basis points of drag, essentially, to have that hedge in place. It's not huge. It's not a huge drag. But there is a little bit of a drag there. Okay. So now it's time to ask yourself, well, what do I think is going to happen? Am I putting this on because we're at all-time highs? Fair enough. Am I doing this because I'm concerned about the geopolitical risks that we were referencing earlier? Like, are we going to take over Greenland by force? Trump said we're not going to do that. I never really bought it. Oh, by the way, when you get those kinds of things and you have a lot of gnashing of teeth, go and take a look at financial markets and see what they say. We have prediction markets now, so just put in Polymarket Greenland, for example, and say, look at the real-time odds. Will he acquire Invade? Here we are. So this is 1 month's worth of predictions on whether or not he was going to invade Greenland. And you can see that it's actually, over the course of the last month, did it go a little bit higher, earlier, and has it come off a little bit? Well, of course it went down today because he said, I'm not going to do it. This flat out said, I'm not thinking about it. But it hasn't really moved around all that much. Okay. So another way you could do this is say, all right, well, maybe instead I will buy a put spread collar. The logic on that being that at some level you become a buyer again, right? So let's go down to call it, we'll go down to 600 just to get things started. Okay. Now, I've sold 2 options and I've collected about $2.60 for that relative to the $6.30 I spent. Now I'm going to get essentially very little drag from cost, because now that total cost for me is actually going to be $1.70. So it's going to be almost nothing. And actually, if we take a look, my actual cost is probably going to be even less. Let's see what the anticipated dividends are. So the X date, well, you're not going to get that. Oh, okay. So the X dividend, so actually you are going to, so this is the 20th. This is the X dividend date. So, or the anticipated X dividend date, I should say. So actually you are going to get a dividend of about $1.99 in SPY. If you held SPY, like, so this is a hypothetical, but you know, if you have some portfolio that's paying dividends, you're probably going to collect some dividends by then. And so in truth, whatever nominal amount of premium you're spending to put this trade on is probably going to be offset, at least in part, by the dividends. Now, if you look at this, you can now think about this and say, okay, well, what's another way to look at this? If SPY fell to 600 from where it is right now, which is a decline of 12.5% or thereabouts, this trade is going to make about $50 or thereabouts, which is 7.3%. So in effect, on a 12.5% decline, you're offsetting about 7.5% of it. Is that good enough? I think for most people it is, right? So I think you have to kind of, in your own mind, say, all right, what do I think is really going on here? How bad do I think it could be? Now, if you're saying, I believe we're going to go into an official bear market, a close-to-close, peak-to-trough decline of 20% or more within the next 60 days, then a straight-up collar is going to be better. But for anything less than that, you know, when you weigh it against its probabilities, I think a put spread collar is probably going to work a little bit better. So that's my my suggestion there. And by the way, it doesn't have to be SPY. You know, I'm using SPY as an example, but of course, you said it's a tech-heavy portfolio. Triple Qs, that's going to be slightly more tech-heavy, and you could do a similar strategy there. Bottle day, SPY and Triple Q still rejected the 8 and 21 day exponential moving average on the pop. Thinking no appetite for buying still. Yeah, well, I mean, you can see actually that, you know, from a technical standpoint, and actually even options play is showing this, is that, you know, in many cases the, you know, it's not overwhelmingly bullish, and I'm seeing that on a host of different technical indicators. Everyone's going to look a little bit different, but yeah. Okay, so FinWest, I see several that overlap with my list: Ralph Lauren, Schwab, Lamb, Micron, Restoration Hardware. In fact, I sold puts on Micron today. Yeah, I mean, it's not surprising that a lot of people's screens are going to look the same, because what are we looking for? You know, we typically are looking for stocks that are above their long-term moving averages. We are looking for stocks that are growing on the top line and preferably the bottom line, and where that growth is accelerating and where the valuations aren't too insane. Some things will show up, like Restoration Hardware does. I see this name again and again on my list, and I keep kicking the tires and looking at it. Restoration Hardware, by the way, is headquartered very close to where I live. But that debt, you know, the debt, the cash balance, like 1% of your debt in cash. just, yeah, it's a little too much leverage for me, especially for a discretionary. It just doesn't seem like there's a lot of room for error there. And their debt's been growing. So if I'd sort of been watching and seeing that their SG&A expense also has been growing a little bit faster than some other aspects. Now, part of that has to do with the fact that they've been focusing a lot on bricks and mortar. They've had this kind of entertainment thing going. So some of you guys may know that RH actually has restaurants in some of their locations. There's one here called RH Rooftop. Maybe that's what they're called at all their locations. I've actually eaten there, not recently. It's okay. I also get a little bit worried about that. Like, oh, well, let's try this and see if that sticks. And maybe we can get people to come in and eat at our restaurant, and then as they're walking past a new living room set, they're going to decide they want to buy that. Well, I don't know. It feels a little spaghetti against the wall for me, and a little levered, but it does keep showing up on my screens, admittedly. Okay, KJ Lemur, also look at Broadcom, similar chart to Oracle. Yeah, so Broadcom's chart might look similar, but the stock to me does not. Let's go back to this. I didn't really talk about Broadcom. So let's just take a look at their financials, because I don't really put these two together as similar. Because the way I think about it is that Broadcom is the recipient of all the good stuff that's going on in the AI space, whereas Oracle is the one that's actually spending the big bucks. So what do we have here? We actually have free cash flow anticipated for next year that is actually equivalent to their total debt. And that's their total debt, not their net debt. Their net debt's $50 billion. So they've got more free cash flow that's going to be coming in than their net debt by a pretty good margin, you know, by well over $1 billion a month. So to me, little different. I mean, growth story, it's definitely a little bit different. So you can have a couple different situations where partially because it's what's going on in the whole space, or maybe people are selling everything indiscriminately. If you have a lot of passive investing, you're going to see a lot of stocks go up and down together because money flows into the market and out of the market. And then stocks are purchased or sold without discretion. But I don't think that they're all comparable. I don't think of Broadcom and Oracle interchangeably in the space, even if their price action is very similar for this reason. Okay, where was I? Hi, Mike. It feels like the small caps will do better than the MAGA this year. I know it's early. Which of the Mag 7 do you like and hate the most? The ones I like the most, well, I like Alphabet still. One of my picks for last year. I still like it now. Let's see. Microsoft has fallen below its 200. A lot of these do seem to be cracking. And actually, it would be nice to see some rotation into the Russell 2K, I have to say. Because to me, that's a broadening out and, you know, benefits real economy. And I feel like that would be a healthy place for us to be. There's something else, which is that, you know, if we do see small caps start to outperform, to me, that it reflects confidence that we're not going to have a big credit problem. Most really big equity markets turn down when you start to see cracks in the credit market ice, and smaller cap companies tend to be more dependent on you know, the capital markets than the large ones do, for the reason I just started. You know, if you got Broadcom in there and they're going to make $68 billion in free cash flow over a 12-month period, they don't need to tap the capital markets. They don't need to borrow money. That's not their problem. But smaller cap companies, they tend to be more subject to the vagaries of capital availability. They need more of it, and they pay more for it. And so to see them do better suggests that the economy is going to have some resilience and that you're not going to have big constraints in the capital markets. So we want to see that action, and I would like to see it. I think that would be healthy for us generally. Let's see here. You know, I mentioned that we had peeled NVIDIA out of one of our funds. It actually has migrated its way back in, but that was because one of the other names came out. So, you know, this trade remains intact, I think. It's still above the 200, so I think we're good with that one. I have also said with respect to Meta that, you know, a lot of people are concerned about this one, and one of the reasons is because it seems like there's this, you know, huge spend on one thing and then there's a huge spend on the other. Is it going to pay off? When's it going to pay off? How's it going to pay off? I get all of that, but my counterpoint to that has been that I've seen that Zuck is pretty responsive when things aren't working. So, you know, he went through several quarters of big spend on Metaverse. The street hated it. They beat the stock up for it. And they said, you know, this is going to take the whole thing down. And then he said, you know what, it's not paying off the way I wanted. Scrap that. We're going to go in another direction. So he's spending a lot of money now on this. And I know that that's got a lot of people sort of up in arms about it. But my guess is that if he's not seeing the movement he wants to see, they will pivot once again. And the company just grows like a weed. And it clearly has the capability to generate massive free cash flow. If it's not, it is not because their underlying business is doing poorly. It's not because they are doing this. They are spending that money and making investments. We will see whether those investments really pay off or not. But I would just suggest that if their run rate capex should have been 30 billion and they decide they're going to put in 110, that's going to be essentially 1 year's adjusted net income. And this, by the way, is the adjusted net. You know, that's essentially what you're losing, right? So you could potentially, if you discount a company by 10 years, it's 10% of the earnings that you could potentially be losing, is one way to think about it. So it is a different way to think about it, but KJ saying Google and Meta are probably the two companies that can monetize AI the best, considering their user base. Yeah, I mean they've got the traffic. It's very different in both cases because to me, Meta is investing in AI, and Alphabet is developing it, and has been in, you know, basically one of the key leadership roles in AI development for at least a decade, right? So I was always a little bit flummoxed. You know, everybody got so excited about ChatGPT and OpenAI, and then subsequently things like Grok and so on. And yet Alphabet, even before they were called Alphabet, was leading in this area. The protein folding, AlphaGo, they're in this space for real and really making a go of it. So I think they both have platforms that can benefit. One is more of a developer, one needs it or wants it, but yeah, I kind of like them both. We are running out of time here. We've run a little over an hour, but let's just take this one on Intel real quick. Intel already ran up a lot before earnings tomorrow. How does a Jan 23rd weekly, March 20, 58, 57.5 calendar look? So that would be selling the near dated, I'm assuming, and then buying, you're looking at March 20, so that's down here. Okay, so that is now what we're going to do. So just keep your eye on this space. I'm going to get rid of listed. I'm going to put tenors in instead. And now I'm going to go back to a year ago. and then we will advance the clock. So when did they report? Well, I actually don't even know that it matters. It's probably going to be right around the same time, so I'll go to the 20. Oh, no, interesting. And we'll go to here. All right. So I need to get back in here. All I'm looking for right now is to just get a sense of what that vol crush might potentially look like. So vol is much higher now. That does present a little bit of a risk for owning those marches. But it fell from, call it 55 to 51. So about 8%. It is considerably higher though now. So we're going to look at 2-month vol, which is essentially what you're buying. I'm going to get rid of this. We're going to look at this over a longer period of time. So the only issue I have with that trade is that this is essentially the options that you're buying. And as you can see, looking back over the past 5 years, that's a historically high level to pay for that tenor, to pay. And if you thought, for example, that it could come back to, you know, an area more like this, which is where it came from, that's 50 vol. Those 58.5s, we can quickly see how much those would, on a standstill basis, how much those would decline as a function of the vol crush by taking a look at their Vega and that move. So again, you were talking about the 57.5s, I think, and the Vega for the 57.5s is about 8.7 or $8.7. Oops, $8.7 times 20. So that's 170. You know, effectively, you're saying that this $5 option could lose, you know, $1.50 to $1.75 just on the vol crush on a standstill basis. So that's the only caution that I might offer, is that I might be a little bit more inclined to be a vol seller going out that far, simply because implied vol for Intel is, as we could see, so far above its longer-term average. In fact, actually, let's just throw some numbers on that, and then I'll move on, because I'm keeping our crack production staff a little bit too long. I don't want to do that too much, but let's just look at 5-year. So again, at the money vol, this is where you're at. Okay. See, in this distribution right here, this is the distribution of volatility prices. You are here. Okay. Putting it differently, mean volatility 40, you are paying 70. That is way, way above average. It's in the 99.7th percentile. And doesn't mean it can't make money, but you are going to need, you're going to need something to work in your favor. And one final point, when you sell the near-dated option, is that going to be enough to take the vol crush out? And you're selling the 58s, those are $1.30. Yeah, I would, if I was going to do a calendar, I'd probably push the short side out just a little bit further, so I'm getting a little bit more premium collection to offset that vol crush, because I think that vol crush is going to be pretty profound in those marches. Just because vols, it is so stretched here. Okay, so with all of that, I want to thank those of you who watched today, and not to remind me too frequently of what I looked like nearly 20 years ago when I first went on CNBC, but I thought you guys might enjoy that. And I look forward to seeing you all here on Monday when we do another one of these things. Thank you very much for watching.